Welcome back, ladies and gentlemen. Let's recap the FOMC meeting because it was not bullish as a lot of people believe it to be. We're also looking at some huge issues in private equity that's going to leave a lot of retail investors as bag holders. And UBS Bank basically already beginning to shut down offices. Long story short, Credit Suisse has basically destroyed a lot of UBS's balance sheet. And we just found out that, of course, they were cooking the books. So let's take a quick peek at this. These are very strong words by Jerome Powell.
Fuck your fucking options. Fuck your fucking zero DTE calls. Fuck the economy. Fuck inflation. Fuck your soft landing. I am sick of this shit. Fuck Wall Street. Fuck you all. I'm fucking out. Fuck your fucking options.
You heard the man. Jerome Powell is not a happy camper today. Zero Hedge came out to say a great point that they finally found the stag and inflation. Guys, Federal Reserve cut 2025 GDP growth from 2.1 to 1.7%. They increased PCE inflation from 2.5 to 2.7% forecast. They increased the unemployment forecast from 4.3 to 4.4%. And they increased the PCE core inflation forecast from 2.5 to 2.8% as well. Now, I didn't say the two of those twice. One is PCE inflation. The other one's core PCE inflation. Both of them are up 2 to 3/10 higher. The Federal Reserve is seeing a higher inflation, as we have been telling you guys was coming. And, of course, a weaker economy. And that's not just them either. Fund managers are now the second most pessimistic on the global economy that we have seen in over 30 years. This is a problem, folks, and people need to be paying attention. Because so far, in case you were unaware, the top 10% of earners in the United States accounts for 58% of all spending. 58% of all spending in the United States is coming from the top 10%. So what does that tell you about the other 90%? That realistically, a lot of people are hurting in a bad way. And there are some ways you can protect yourself. We're going to talk about that here shortly, especially in regards to some of these firms and their not so great private equity deals in exchange for debt. But they said here, bar chart says that the only time they were more pessimistic was the onset of COVID, which, as you guys know, well, I won't even say anything about it. I think you guys know how I feel about that. But that was, of course, very artificial. What we're seeing now is the worst we've seen in 30 years. And fun fact, Jerome Powell said that higher goods inflation is likely related to tariffs. The reality is, though, here's our friend Dario very eloquently stated, is that, fun fact, tariffs were not yet even being implemented when the latest inflation data was reported. So apparently, Jerome Powell is lying. And yes, again, guess what? We're getting back into transitory territory. Getting back into transitory territory. Did not expect to say that today. This clip, Kobesai Letter says, is from almost exactly 11 months ago. Jerome Powell was asked about stagflation, and he said he's not seeing the stagnation or the inflation. Only 11 months ago, not even a year, folks. Today, the Fed raised both unemployment and inflation forecasts for 2025 while cutting GDP growth estimates. We are now seeing the stag and the inflation that I've been telling you guys is right around the corner, and it has arrived.
In addition, I would say, most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%. And that won't be, so I don't see the stag or the inflation, actually.
Zachary in the comments says, sounds like the Fed is going to turn on QE to infinity starting in April under the guise, of course. But I completely disagree with you on that, my friend. We are not going into QE anytime soon. The Fed is not going to start the Fed money printer unless something crazy happens and markets just collapse. QT is here to stay, and I'll explain exactly how that's going to happen. But, of course, Fed Chair Powell was asked if tariff inflation is transitory, and he said, that's the base case. How did we end up back at inflation is transitory? That's where we're at now. Jerome Powell is blaming the inflation on tariffs that were not even implemented or in the process of being implemented when inflation numbers last came in. How can that be? Oh, yeah, it's impossible. Now he's all, of course, saying that inflation is transitory. Once again, that is the base case. And we know what happened the last time around. It hasn't been the first time nor the second time. And of course, that's not the truth. Now, economist Mohamed El-Erian brings up this good point, and I don't often agree with Mohamed El-Erian. But on this one, I have to say he is right on point. The word transitory is back at the Federal Reserve as Chair Powell characterizes the price effects of tariffs as a one-off. I would have thought that particularly after the big policy mistake of earlier this decade, and given all the current uncertainties, some Fed officials would show greater humility. It's simply too early to say with any regress of confidence that the inflationary effects will be transitory, especially given that companies and households still have fresh in their minds a recent history of high, unanticipated inflation. Ladies and gentlemen, I do have to disagree with the last portion because the inflation was anticipated. Janet Yellen told us that the inflation was going to be out of control in 2021 before it actually occurred. We again in 2021, guess what? We were here on this channel telling you guys about it. This is not an I told you so. This is a if you pay attention, they tell you the reality of what's actually happening. And they slide it under the door very quietly. Now you can see here, the Fed is holding rates steady. The median of the rate cut forecasts are unchanged from December, still at a 2-cut median. They're slowing their treasury runoff of QT to $5 billion per month. Now, they're doing this specifically so that they can maintain the QT ongoing for as long as possible. That's exactly what's going on here. They said that recent indicators suggest the economy activity has continued to expand at a solid pace. Of course, not without reducing the GDP of the country, they said. The unemployment has stabilized at a low level in recent months, and labor conditions remain solid. But of course, uncertainty around the economic outlook has increased. Beginning in April, the committee will slow the pace of decline of its security holdings by reducing the monthly redemption cap on Treasury securities from $25 to $5 billion. The committee will maintain the monthly redemption cap on agency debt and mortgage-backed securities at $35 billion. So they're still reducing their Treasury sheet by $35 billion in the form of agency debt and mortgage-backed securities, but they're reducing the sell-off of their Treasury securities because they're well aware that there's not enough buyers out there for the massive number of treasuries out there. So they have to keep up the charade for as long as possible. Now, what did he say? The summary is, the economy is strong. Inflation remains somewhat elevated. Tariffs have driven inflation expectations higher, although tariffs were not even being implemented when inflation numbers actually came in. Because, of course, these are lagging numbers. The Fed is not in a hurry and will await further clarity. Further meaning we are going to keep up QT for as long as possible. QT is not going to stop. We just slowed it down so that we don't collapse the economy. They said the Fed is not, they said that if the labor market weakens, the Fed can ease if needed. If the economy remains strong, policy restraint can be maintained. They also said that they made a technical decision to slow balance sheet decline. Now, that technical decision, as we just stated, is not for any other reason other than the fact that we're already seeing the economy start to pull back, especially now that we're not seeing all of the fake job numbers and fake reports that we were saying under the Biden administration. Cheers, Zachary, Larry, you, Eric, Terry. Thank you, ladies and gentlemen, for being here with me. The Pentagon is about to lay off 60,000 civilians in jobs at the Defense Department. That's a 5 to 8% workforce reduction, and 21,000 employees have taken voluntary resignations, while remaining positions will be eliminated through attrition. We are just getting started, folks. The worst is yet to come. Stock Talk Weekly says that the White House economic advisor, Kevin Hassett, spent last night with the Commerce Secretary and the Treasury Secretary, Scott Bessent, negotiating with other countries about mutually lowering tariffs before the April 2nd deadline. And it ain't over, folks. Everybody knows it's not over. The tariffs are going to continue to increase, and we need them in this country. And guess what? Those people claiming that they're bad for our country could not be more wrong. I understand why the talking points that we've heard over the last couple of decades have stated as such. But just like in 2016, the tariffs actually did a lot for our economy and our country and brought a significant number of jobs and manufacturing back to the States. As such, NVIDIA CEO said today that NVIDIA is preparing to manufacture onshore in the United States. Let me get a slow clap, folks. Let me get a slow clap, a little golf clap for good old Donald Trump here, bringing jobs and manufacturing back to the United States because of the higher tariffs. Again, this is a trend that we're going to see continue. Siemens, the global electronic firm, is cutting 6,000 jobs worldwide, including 2,850 in Germany, affecting their automation business within the digital industries division and electric vehicle charging business. Layoffs completed by September 2027. This is going to be a slow burn for them, and this is something that's going to continue for a lot of other firms. Morgan Stanley, one of the biggest banks in the world, laying off 2,000 employees later this month in their first major workforce reduction under CEO Ted Pick. Way more layoffs coming for Morgan Stanley and a lot of these other firms. Why are these banks, if they are so profitable, bringing in billions of dollars, laying off thousands of people, folks? Because the reality is finally setting in. Now, why are private equity firms borrowing money to pay investors at record levels? Folks, buckle up. Some of these private equity firms are invested in companies that have a ton of debt. They're pulling off a financial magic trick here, if you will, and that's going to benefit them. They're putting money in their own pockets, and it's going to leave a lot of everyday retail investors in the dust. So they're using unusual exit strategies here, selling companies or taking them public, and they're failing because the market is doing so poorly. A lot of these public equity firms are opting for dividend recapitalizations. Now, dividend recapitalizations are, instead of selling companies to generate returns, they load up their portfolio companies with crushing debt in order to pay themselves massive dividends. They bleed the companies dry, and they can keep up the appearances of an increasing balance sheet, and they walk away with money in their pockets, leaving the actual businesses themselves and the remaining investors in those debt-laden companies to deal with the fallout. For example, I'm not sure if they have the example here, but Clarius International, who's a battery manufacturer, borrowed $4.5 billion so that their private equity backers could cash out. The debt that this company has doesn't go on the PE firm's books. It gets dumped onto Clarios, the battery manufacturer. And when Clarios eventually buckles under the massive debt that they're undertaking, retail investors that bought them into their stocks or bonds could be left with worthless shares or collapsing valuations. There's zombie companies being created. They're debt-laden companies that have poor revenues and poor profits, but they're essentially walking corpses because they look fine on the surface. They're struggling to grow, they're struggling to innovate or even survive. And once those firms that can't pay down their debt extracted their cash, they have no real incentive to keep the company's healthy. They're left staggering under enormous debt, slashing costs, laying off people, and facing bankruptcy risks. Now, if you're an investor in a public company that's been milked by PE firms, now this would not be something that I would attribute to companies like GameStop or AMC, mostly because both of them have paid off all or the majority of their debt and have hundreds of millions, if not billions of dollars in cash on hand, and are generating hundreds of millions or even billions of dollars in revenue each year and each quarter. But some of these other firms like Clarios that are significantly in poor positions, once their real financials come to light and the market realizes how much debt these companies have taken on, their valuations are going to tank. And the PE firms don't send out warning letters when they execute these deals. By the time the damage is obvious, they've already taken their winnings and they've moved on. A lot of people are sitting on a financial landmine until it's too late, and they won't even know what happens until it does, right? The credit downgrades in junk status is incoming as they load up on debt to pay the PE dividends. The credit rating agencies could downgrade them to junk status and make borrowing more expensive for them, pushing them closer to the edge here. Now, you can actually protect yourself from this because before you invest in a company, this is not financial advice, but you can check the debt levels. If the debt to equity ratio has spiked and it's been involved in a private equity buyout specifically, beware. You can watch out for dividend recapitalization deals. A company suddenly takes on billions in debt in order to reward their investors. That's a huge red flag. Think to yourself, have you seen any large companies out there do this on the S&P, in the stock market? I know I can think of a few just now. Honestly, a lot of private equity heavy exchange traded funds or firms that holding these risky debt laden firms are very, very problematic. And unless you're comfortable with the gamble and willing to put that money on the line, you should probably ask a financial advisor if it's a good idea. Thanks, Nat. I appreciate you as well. Rad says, I know Jerome Powell lies because his lips are moving. He thinks we're dumb. Could not be more right on that. Now, private equity firms have found this new way to cash out and are leaving retail investors to be the ones footing the bill. The same thing's happening with a lot of people's pensions and 401ks, IRAs, and ISAs that you're not self-managing. So these firms aren't just playing with people's money. They're rigging the game, cashing out at the top, and leaving everyone else to suffer the crash and burn. So if you're not paying attention, be careful because you could be holding a ticking time bomb. Now let's talk about UBS. Because UBS is in fact a ticking fucking time bomb. Let me expand this a little bit for you guys to be able to see this. Excuse me one second. Wrong button. UBS is bracing for the most complex phase of their Credit Suisse integration. If you didn't see the video we did on Friday, discusses in depth all of the toxic derivatives that UBS has taken over from Credit Suisse, which took them over from Archegos. And of course, Archegos had a ton of bad bets on, stocks like short bets on stocks like GameStop, AMC, Silver ETF, SLV, and such, as well as when they collapsed. Well, that left Credit Suisse holding the bag of odorous excrement that, of course, when they collapsed for the very same reason, fell onto UBS. Now UBS is shuttering their outsourced trading desk, which was one of the biggest in Wall Street, period. And they began informing clients of the decision and gave them 3 months to find a new provider. They're not closing their execution hub, but they are closing their trading desk. Now, outsourced trading desks cater to asset managers and hedge funds and can act as a backup when client staff are out of pocket or provide extra help during busy periods. They can even replace an investor's trading desk entirely, handling all the orders for the hedge funds or for their private clients. Money managers have increasingly turned to outsourced trading desks as the global shift to passive investing has put pressure on their margins. And of course, they say they continue to focus on growth and remain dedicated to our clients as we service them, blah, blah, blah. But you can see that the Swiss government's not having it. Swiss lawmakers are shortening the leash on too big to fail banks. This article just came out yesterday saying Switzerland's parliament backed all proposals for regulation of big banks made by the investigation committee into the demise of Credit Suisse, completing a procedural step that will influence the government's draft law on UBS capital requirements due in May. We're seeing a fucking margin call in the making, folks. Increased capital requirements means margin call if they don't come up with the money. And of course, in order to come up with the money, what do they got to do? Probably fire sale some assets. So, lawmakers in the Senate voted in favor of sending proposals to the government after the House of Representatives already backed them the previous week. The possibilities for granting any relief on capital and liquidity requirements for systematically relevant banks should be limited. This means they are not looking to give money to these banks. Any easing should be reported transparently, be subject to a mandatory time limit, and accompanied by a clear phase-out plan. Meaning if we have to bail them out, it's going to be reported out to the public so everyone can know about it, and there could be financial runs in the making. The financial regulator there, FINMA, which is alike to FINRA in the United States, should be strengthened and be on equal footing with big banks. Among other options, lawmakers call on the government to examine giving FINMA the power to fine banks and managers. The Swiss National Bank should get the power to require from banks a preparation of collateral so they can, in a crisis, draw on a sufficient amount of emergency liquidity from the central bank. Meaning, we can lend your collateral to the central bank, and if that's not enough, we will fire sale those assets in order to make sure that we get our money. The purpose of Switzerland's regulation of big banks should be revisited. They voiced fundamental concerns, including the regulation being too focused on Switzerland. An overhaul should take into account compatibility with international rules. Now, they continued on here. Where did it all go wrong for Credit Suisse? Well, one could say is they didn't keep an eye on their hedge funds and their family offices, hence Archegos, multiplying their leverage 60x. Heavily shorting companies like GameStop and AMC, and going long on companies like Viacom. And when companies like Viacom dropped in value, well, they got margin called. And then when companies on AMC and GameStop started increasing in value, then they had to start closing short positions. But guess what? The big problem is that so many of these derivatives were OTC contracts, swaps is the contracts. There's no way in the world that Credit Suisse could actually, that Archegos was able to close them all down. So the vast majority of those toxic derivatives remain up in the air. Hence, that is why we like to say that UBS is rearranging the chairs on the Titanic because, according to one of my contacts, says Just Dario, UBS is expected to make an effort to wind down as many legacy Credit Suisse positions as possible in the upcoming OPEX this Friday. OPEX stands for options expiry date this Friday, so just in a couple of days. If they decide to go hard, they alone can trigger significant volatility like it happened when SG unwound Kerviel positions. Folks, take your seat, pick a deck chair on the Titanic. Shit is going down. Now, this is speculation. I don't know if this is going to happen. But what I do believe is that if UBS unwinds a majority, or just to say unwinds any sort of significant portion of their positions from Credit Suisse, because they are still holding them, and as I showed you on the last video yesterday and the one on Friday, UBS is taking over all of the Credit Suisse derivatives on March 20th, this OPEX, this options expiry date, this Friday. I do not believe that UBS will close out all of those swaps and short positions held in companies like GameStop and AMC, because that would be so massive that if unwound and unraveled all at once would cause the mother of all short squeezes, not just in these companies, but in all of the other companies that are traded within these same baskets of consumer discretionary products, GameStop, AMC, and all of the other consumer discretionary that you can think of. This is huge news. And unlike the private equity, debt-laden bullshit that you guys have been seeing here, there is a lot less risky private equity opportunities out there. Now, of course, there's still risk, but so far, over 350 retail investors have invested in Lit Exchange, the upcoming stock and crypto broker designed to protect you from market manipulation, delivering bleeding edge innovations, artificial intelligence that allows you to harness the power of swarm intelligence and thousands, if not millions, of your best friends that are invested in similar companies. Now, so far, and due to this, you can go to the FINRA regulated funding portal called Silicon Prairie, and there you can invest in the company. But of course, do all your due diligence. Check out the pitch deck, the business plan, the auditor's reports, yada, yada, all the SEC Edgar investment disclosures, which you will find for Lit Exchange on the SEC Edgar website, directly linked from our website and the FINRA regulated funding portal. And you will then have the opportunity for the first time in the history in the world to invest in a firm, a stock and crypto brokerage firm, before its launch and before its planned IPO. Ladies and gentlemen, I will leave you with that. I wish you peace and wealth. I hope you all have a great day. Thank you, Beverly, Terry, Boris, Bernie. You ladies and gentlemen are amazing. Huge shout out to all the Lit Exchange founding members. Do what you can, ladies and gentlemen, because this is actually a once-in-a-lifetime opportunity, and you will not be seeing it again. Cheers, my friends. Oh, yeah, Boris, the SEC did, in fact, drop the lawsuit against Ripple. Surprise, surprise. Now that Gensler's gone, all of the bullshit lawfare seems to be going along with it. And in case you were wondering, Scott Bessent is up to be nominated for the new SEC chair position here at the end of March. I believe March 27th, we will be seeing the new SEC chairman nominee, Scott Bessent, going before Congress in order to have his nomination completed or approved, if you will, right? So I'm very much looking forward to that, because so far Hester Pierce and Mark Ueda have not exactly done much to help out retail investors. They've declawed the cat system. They have, well, I'll just leave it at that. I'll save that for tomorrow's video.